in which it has been given, I would gather that what is important is that what is the character of income, what was the mode by which I had received the income, realized the income. So as I could see, on a back-end calculation is there could be 4 apparent ways in which a person could receive income. One is of course in cash, other one is by check, the third one is in a barter I could receive, and the fourth one is that see, income has accrued but I have not realized it. So I would take a view that something which has not been realized, that is standing in a credit, or something which is in a form of a barter, they would be outside the window of this new prescription of 199C. But if I can establish that I have received income in cash or by check, that is the income which should be permitted to be declared, because the objective which is there behind this new prescription are given of go by altogether. Neither it is held as on 811 nor it is held in high denomination currency. What you are actually doing is you are facilitating an income disclosure, and which is nothing but an IDS 2, that those who miss the first bus can travel in the second bus. So if that is so, answer to question A for the one for Mr. A would be that he in any case has received it in cash and which has been deposited in bank. So which is on all fours as far as the law is concerned, he is welcome to make a declaration. As far as B is concerned, he has received the money in cash, that is income, but he has spent that money on his son's wedding. Now here, that because of the peculiar nature in which form 1 is worded, it is possible that that income could be declared in the form of cash, and you will be getting immunity in respect of that income. You will never get an immunity on account of the expenditure which you have incurred. Having said that, if you are in a position to establish the nexus between the income in cash which you have earned and the expenditure which you have incurred in cash once again, I would believe that it should satisfy the requirement of the law of 199C. If you agree with me on this, which is not something which is very, very clean, it is debatable. But as far as C, if you agree with me on B, in case of C also, as long as he is declaring an income in the form of bank receipts or a cash receipts, its application is not something which is required to be declared. What we are concerned actually in all 3 questions is the application. 199C does not deal with application. And what is very important and should be a clinching thing in my opinion is that if you see the board's answers, is continuously it is saying that it was not being held by you in this fashion. When you go to 199C, it nowhere uses the term held by you in cash or bank deposits. In that view of the matter, there is a good possibility that yes, that all 3 should qualify for making a declaration as long as what is being declared is an income which is received in cash or by way of a bank deposit. Thank you.
Next question 5, Mr. For Ganesh. Taxability of gift of shares by company. A private limited intends to gift its shares to its shareholders. What are the implications under the Income Tax Act, read with Section 222 and Section 5627? Would it make any difference if the gift is given to the relatives of the shareholder, or it will be formed by the shareholders?
I take it that this question refers to shares held as an asset by a private limited and not its own shares. Now, Section 2, subsection 22 lays down very clearly and unequivocally that if a company has accumulated profits, whether capitalized or not, and it parts with its assets, either in cash or in kind, in favor of its shareholders, then that straightaway, without anything more, constitutes dividend within the meaning of Section 2, subsection 22. So I have no doubt at all in my mind that if a company which owns certain shares distributes those shares in specie as such to its shareholders, then, and it has accumulated profits, whether capitalized or not, then that distribution would constitute a dividend within the meaning of Section 2, subsection 22 with all the attendant legal consequences. Now, having said that, I would also wish to make it absolutely clear that such a distribution of shares by the company would never attract the provisions of section 56(2)(7) of the Act, because this cannot possibly be considered to be a gift made by the company to its shareholders or a receipt of assets without any consideration by the shareholder. The consideration against which the asset is being received by the shareholder is the fact that he is a shareholder of the company and the amount is being distributed to him by the company to the shareholder in his character as a shareholder. Otherwise, the ridiculous consequence would be that even an ordinary declaration of dividend by a company in the ordinary course by a company to the shareholder would also attract the provisions of section 56(2)(7), which I think has only to be stated to be rejected. Now the next aspect of the question is, can the gift be given to the relatives of the shareholder? I am a little confused and mystified as to how a company can make a gift of assets belonging to it to the relatives of a shareholder. Now the only situation in which I can conceive of such a distribution taking place is if the shareholder instructs the company that instead of distributing these shares to me, which I am entitled to receive as a shareholder, please give it to Mr. X, who is my brother-in-law or who is related to me in some way. Such a distribution by the company, I would think, would be for and on account of the shareholder, and therefore that again would be dividend. And if it is some gift which is made by the company to a person without having any connection at all to that person being a shareholder, I would imagine that it would be ultra vires the provisions of the Companies Act. And even if such a gift is made, then I would think that it would certainly attract the provisions of section 56(2)(7), because 56(2)(7) is not concerned with whether the gift made is legal and whether it is in conformity with the provisions of the Companies Act or not. And such a relative receiving it cannot possibly claim the benefit of the exception which is provided to section 56(2)(7), which speaks of gifts received from relatives as defined in the explanation to section 56(2)(7). Because a company, being a corporate entity and which is an entity only in law, cannot possibly be said to be a relative of any person, even though you may have received it in the strength of your being a relative of a shareholder. Therefore, if such a distribution is made by a company to a relative of a shareholder, and it has nothing to do with the instructions of the shareholder and purely at the whim and fancy of the company itself, which is highly unlikely to me, I think it would attract 56(2)(7), and the exception or exemption which is contained in the section would not be available.
Question 7 to 35. Afterwards, please.
Yes, you are right. The same thing would apply to AOP, because the AOP is not a shareholder. Exactly. I know, but then the AOP cannot be a shareholder of the company. AOP cannot be a shareholder of the company. So if a distribution made by a company to an AOP, it either has to be under the instructions of the shareholder or dehors any such instructions given by a shareholder. If the shareholder gives the instruction to the company that please, this amount of asset which would otherwise come to me, give it to this AOP, then I would regard that as a distribution made for and on behalf of the shareholder, and therefore that would attract 22 and it would be deemed dividend, and it would not attract 56(2)(7).
Next question number 7 for 35. Partnership form 4 partners. There are various, the firm has various agencies in business. Now 2 partners, Lal and Bal wants to retire. Pink wants to take over the shares. Friends, in agencies these words have to be removed. The 2 partners, they want share of a partnership firm by paying rupees 50 lakhs to the retiring partners and show the payment as intangible rights in his books of account and claim depreciation. We have to advise Mr. Ping and also clarify taxability in the hands of Mr. Lal and Bal.
There has been a clarification which Sharmaji told you is that what Pink is acquiring from Lal and Bal is not the share in agency, but it is share in profits of the partnership firm, Red Rose. That is a fundamental thing, because otherwise it will be something else. Okay. So what is being acquired is a share in profits of the partnership firm, assuming that such thing is possible, directly without the consent of other two continuing partners. Because under the LLP Act, there is a specific admission of this, that you can do so, you can separately transfer, but under the Indian Partnership Act, there has always been a debate that you can independently. But assignment, therefore one would believe that what is happening is an assignment by Lal and Bal to Pink for a consideration of rupees 50 lakhs. The query also does not tell us that what is the business of Pink. Is he in the business of getting into partnership? And by virtue of that, he is, entitled to profits. His main business would therefore be that getting into several partnerships. If that is not so, which I assume it is not so, then with this background, let us address the question in short is that his first question is whether would he, on this payment of 50 lakhs, be entitled to depreciation. The claim appears to be under explanation 3 small b of 32(1), which defines intangible asset and whether this payment could be considered as an intangible asset or not. Now one would see that in order for a valid claim of depreciation, A, you need to acquire an asset, you need to be an owner of asset, you need to have used it, and that user should be for the purposes of business. For the purposes of business. Then in such circumstances you would be. So coming back to my initial issue was that is Pink in the business of acquiring partnership? The answer would be apparently no. So having therefore acquired a right to share in profits, assuming that there is so much, but against which income he would claim a deduction. For the time being, if you consider that he has been using this intangible asset, which if it could be said to have been acquired, the issue would still there be that against which business income he wants to claim a depreciation. Apparently, he would claim it against the share in profits of partnership firm, which otherwise is not taxable by virtue of section 10(2)(a). So, unless there is some case which is made out of being in receipt of a taxable income on account of this investment, which receipt is otherwise taxable as a business income, then only there will be a case for depreciation. However, if we are bent upon claiming a depreciation, then there is a Gujarat High Court decision which has said that when a payment has been made by the partnership firm to the retiring partners and that payment has been construed to be a goodwill, then relying on Supreme Court's decision in Smith Securities Limited's case, it has been held that that when you classify it as a goodwill and if the AO is not challenging, it is the firm which will be entitled to claim a depreciation, not the incoming partner who will be claiming depreciation. The other part is something we'll spend a couple of minutes on it because it is a larger issue and there is a serious conflict on it. The sum and substance of it is that whatever amount which has been received by the retiring partners Lal and Bal aggregating to 50 lakhs rupees, would it be taxable in the hands of the retiring partners or not? We have 3 famous Supreme Court decisions which have one after another held that if the retiring partners have received something which was due to them and which amount which is in excess of their capital account is paid to them by taking a notional sale of the value, notional sale on the basis of the notional value of the assets and the liabilities, and if there is a surplus and if the retiring partner is paid a surplus in the firm, surplus in the retiring partner is paid, a share in the surplus, then in that case it would not be taxable. Now these decisions, actually were fallout of a series of 3 decisions delivered by the Bombay High Court. In T.G. Patel's case, which has been later on reversed by the Supreme Court, N.A. Modi's case, which has been referred to in the query, and the earlier decision was H.R. Aslov's case. 2 of them were reported in 115 ITR, the last one, Modi's case, is reported in 161 ITR. In this case, the Bombay High Court consistently took a view that when a partner assigned his interest and for which he received a consideration, it was taxable in the hands of the partners. One thought that after 3 decisions of the Supreme Court, the issue is settled, and therefore whatever a retiring partner receives should not be taxable. But that has not so happened. If you would see the later decisions, Sevatilal's decision, Kanodia's decision, and importantly Sudhakar Shetty's decision. Sudhakar Shetty's decision is a decision which has carefully examined all the aspects of this, that Mr. Vasudevan delivered the decision, wherein he stated that there is a distinction between the ratio of the Supreme Court decisions and the Bombay High Court decision. He stated that one will have to examine that what were the facts on which the retiring partner was paid a consideration. If it was on account of a notional sale of assets, by ascribing the notional values to the assets and liabilities, and excess over the capital account balance has been paid, being a share in the excess, then in that case, it will be on all fours within the Supreme Court decisions and it would not be taxable. Howsoever, if the retiring partners have chosen to assign an interest for a consideration, the ratio of the decisions of the Bombay High Court would continue to apply with equal force and would be taxable in the hands of these. Now, these later decisions are something, which are yet to be examined by the courts. Maybe a Supreme Court has forever decided that whatever retiring partner is receiving is something which he is otherwise entitled to, either by way of assignment or on account of a notional accounts, is something which would remain open in my view. Thank you.
Next question 8. Whether interest paid on loans taken from NBFC for making application can be added to the cost of shares allotted while calculating short-term capital gain on sale of shares allotted in IPO. SSC is not a trader, he is accepted as an investor by the department.
I'll take it. Yeah, the rest of it, I'll just introduce you to some of the questions. Question number 1 is that, that whether the interest which has been paid, which has not been claimed as a deduction, a revenue expenditure, could it be loaded and capitalized to the cost of shares and being claimed as cost of acquisition for Section 48? I believe, barring a couple of decisions, there is more or less an unanimity as regards the interest capitalization for the purposes of Section 48, subject to a condition that it should not have been claimed as a revenue expenditure. So this we can reasonably take it as a settled position in law, that if you have borrowed something for the purposes of buying shares, but the issue which follows is that what if you have borrowed money for the purposes of making an application under IPO? You borrowed 10 crores of rupees, you made an application for 10 crores of rupees, paid 1.20 crores by way of interest, and the shares which have been allotted are just of the value of 1 crore of rupees. So should you be capitalizing 12 lakhs rupees or should you be capitalizing the entire 1.20 crores? This issue also appears to be reasonably clear by the decisions. We'll have to refer to the decisions. I could take you into the concept of cost of acquisition, assuming that time was there, but which is not there. So in such circumstances, the tribunal have been consistently holding that even if the shares which are eventually allotted are 10% or whatever percent, the entire interest which has been paid for making an application, by virtue of that application, the entitlement was restricted to an amount. If he had not made an application, he would not have got any shares at all, and said therefore in such circumstances there should not be a difficulty in loading it to the cost of acquisition. The interesting issue which however remains to be examined is, or in respect of which there is a dispute amongst the decisions courts, is that what about the post-acquisition period? You have borrowed the money, you have acquired the shares, and the interest paid up to the date of acquisition of shares is something which we are clear that that it is allowed to be capitalized. In the context of the depreciation and section 43(1) also, Chailroop Sampatram held that this interest should be capitalized. But the issue here is what about the post-acquisition period? Till the time you realize the shares, you are not in a position to repay the loan, and therefore the interest continues to be loaded. Can you really load these to the cost of acquisition? There is a conflict of views. Some of the tribunals have held that post-acquisition period is a revenue expenditure, and therefore it should have otherwise been claimed, and if you could not claim it because of 14A, it's your funeral, law is not otherwise concerned with it, and we will not allow you to load it on the cost of acquisition. As against that, there are series of decisions which have been holding, which have addressed the issue, not specifically of post-acquisition, but which have addressed the issue whether interest could be capitalized in the 10th year after having acquired, and whether all those 12 years interest, that is 2 years prior to acquisitions and 10 years post-acquisition, the courts have held that yes, interest could be allowed to be loaded and it could be capitalized. Then whether 14A issue would come into that or not. See, 14A, as Ganesh nicely explained, is that it is dealing with disallowance of an expenditure. It is not dealing with disallowance of a cost of acquisition. And in that view of the matter, something which is loaded to the cost of acquisition should not face difficulty under section 14A. Howsoever, if you were to claim it as a revenue expenditure, there could arise a difficulty by virtue of 14A. And this is also one good one, that whether can you index the cost of acquisition by loading interest. If you do so, every year you have been loading the interest. Then in such cases, see what would be the base year for claiming indexation quotient. Will it be the year one in which you have acquired the shares? Will it be the year in which you have borrowed the money? Or will it be year wise? And therefore, it could perhaps be considered as a cost of improvement. Again, there is conflict of view. Largely it appears that, that the base year and the correct position, if you read the definition of index cost of acquisition in explanation to section 48, what is relevant is the base year of acquisition. It has nothing to do with payments, it has nothing to do with payments in installments, and therefore once you accept in principle that what is being allowed as a deduction in computing the capital gains is cost of acquisition, then in that case there would not arise a difficulty whereunder you will have to yearly index it. In fact, doing something, whereunder you want to allow an indexation on a yearly basis, I would believe that you would be really doing a serious violation to the provisions of section 40.
Okay. Next question number 9 for Mr. Ganesh. Mr. Bhanu deceased. He bequeathed the flat. It was and 3 sons were legal heirs. His two daughters challenged, and the 50 lakhs each was paid to them. The question is whether that amount can be part of the cost of the deceased. Or second question is, would it be better that their 3 sons sell the flat after adding proportionate cost and pay tax applicable to each of them?
2 questions immediately spring to my mind. One is, who provides the 50 lakhs plus 50 lakhs to pay Ms. Manjari and Ms. Khanjari? And secondly, what is the basis of the claim made by them, which is supposed to cast a shadow on the title to the flat so far as the 3 sons are concerned? So instead of raising and attempting to answer these very interesting questions, I would suggest that we adopt a tax efficient method of ensuring that the amount paid to those 2 ladies is allowed as a deduction in the computation of the capital gain arising to the 3 sons on the sale of the flat. And the method which I would suggest, which would not involve the making of a single incorrect or misleading statement to the revenue, would be that the 2 daughters, Manjari and Khanjari, should send a letter or a notice to the executor in which they specifically contend that during the lifetime of their father, Mr. Bhanu, there was a clear family understanding or arrangement to the effect that they would get the amount of 50 lakhs plus 50 lakhs and the sons would take the flats only subject, the flat subject to their right to get 50 lakhs plus 50 lakhs. And on the basis of that family understanding, which they say has not been recorded in writing, but in respect of which there is material or evidence to prove it, they can call upon the executor not to transfer the flat to the three sons or not to allow the flat to be sold till such time as their entitlement of 50 lakhs plus 50 lakhs is satisfied. On receiving that notice, making that claim of title from the two daughters, the executor can then convey it to the two sons and then he can call upon them to satisfy the claim of the two daughters or to have that claim disproved by a litigation in court. Now obviously the sons would then enter into a formal written understanding with the daughters saying that we will pay you this amount of 50 lakhs. So they may or may not have liquidity for that purpose, but let me assume that they have the liquidity. They can then raise that amount of 50 lakhs, pay it to the two daughters, get a complete discharge from them, and on producing that discharge they can get the flat transferred in their favor by the executor and then sell the flat. If this modus is adopted and this documentation is prepared, then I have no doubt in my mind that the amount of 50 lakhs plus 50 lakhs which is paid to the two daughters would unquestionably be allowed as part of the cost of acquisition in the hands of the three sons, because without incurring that cost they would not get saleable and marketable title in respect of the flat. Therefore it would, without any doubt whatsoever, constitute a part of the cost of the acquisition of the flat in their hands. And therefore, when they sell the flat, they can certainly take into account the amount which they have paid, that is 1 crore divided by 3 in the hands of each person, and claim it as a deduction while computing capital gains in their hand. This, I think, would be the best, most tax efficient method of dealing with the matter and which is most likely to succeed.
Question 10 again for Mr. Ganesh. An SSC having agriculture income, also having business and other income regularly assessed to tax. He has received 1 lakh from state government as compensation against loss caused to crops and rupees 50,000 against loss of raw material pertaining to other business due to unscheduled rain cyclone. Whether the receipts are taxable.
We have a long line of judgments, starting with English cases going back to about 80 or 90 years, as to when a receipt by way of compensation can be considered to be a revenue receipt and when such a receipt can be considered to be a capital receipt. And the clear and unequivocal test which has been laid down and reiterated by the courts again and again and again is that if the amount of compensation fills a hole in the assets of the assessor, that is a loss which he suffers in his capital assets, then it is a capital receipt. And if on the other hand, the compensation fills a hole in the profits of the assessee, it is considered to be a revenue receipt. Just one simple illustration will suffice to drive home the clarity of this principle. If an assessee's factory building is insured against lightning damage or some other damage because of natural calamity, and that building is damaged and compensation is received from the insurance company, then that compensation would be a capital receipt. If on the other hand, his stock in trade and work in progress, that is insured and that is lost because of some natural calamity or a fire, and an amount is received from the insurance company towards that amount, towards that loss, then that would constitute a revenue receipt. So in the present case, the crops unquestionably constitute the income of the assessee, whatever income he receives. It may be agricultural income, it may not be, that is a separate question altogether. But the amount which he receives from the state government as compensation against loss caused to crops would, to my mind, certainly be considered to be a revenue receipt. And it would also constitute a non-taxable revenue receipt if you can show that the crops constitute agricultural income. If on the other hand, the amount received is against the loss of raw materials which relate to a business, the income of which is taxable, then that receipt would constitute a taxable revenue.